we're going to talk about a new, how do I want to describe it? A new way to recalculate an old indicator. Now, moving averages are one of the most well-known, most well-used indicators in the marketplace. And moving averages are the basis for a lot of technical indicators that we know. Like MACD uses moving averages to calculate the MACD line and the MACD signal line. Bollinger Bands uses a moving average line and then calculates two standard deviations above and below that moving average. So an important step when evaluating a trading plan or method is to comb through the tools currently employed by a trader to determine exactly what the new approach might bring to the table. So tonight we're going to talk about Bob. Bob's my test subject. So to illustrate the process of finding the right tools, we'll use the experience of one of my clients, Bob. Now, Bob was looking for a technical trading tool that was easy to use, did not require intraday monitoring, and could help him be more successful. Now, Bob was pretty market savvy, but he was tired of using the same indicators that everybody else had been using for years. He wanted something unique that might give him a competitive edge. Now, there are literally hundreds of methods, thousands of indicators and strategies out there. So how does one find a new approach to identify or use these tools? So in Bob's case, he's been using moving averages of various durations. He might be using a 10 and a 20 period moving average. He might be using a 30, 60, 90 moving average. He might be using an EMA, an exponential moving average, or he might be using a simple moving average, or he might be using a moving average crossover. But, however, Bob's moving averages weren't working out so well for him now. Now, while moving averages filter out the random noise in price data by smoothing price fluctuations, due to its construction, this technical indicator lags behind the market and therefore will always be late in forecasting a trend change. So whether you're using a simple moving average or any of the indicators that are based on moving averages, they're always lagging. Now remember, lagging and leading are descriptions of indicators. They don't sound like the word. Leading sounds like, it's great, it's ahead. Lagging sounds like it's bad, it's behind. If your school called you and told you your kid was leading the class, you'd be a proud parent. But if the school called you and told you your kid was lagging in class, you'd be kind of disappointed. It doesn't work that way with technical indicators. Technical indicators are lead the market. They're in front of what is happening. They're trying to predict future price movements. Where lagging indicators confirm a movement. Most indicators are lagging indicators. And that's because they have to use the price calculations or the calculations based on price. And so since the price has already occurred, they're always behind what's happened in the markets. And this is a problem for all of us. Okay, all of us, because this means that buy and sell signals based on a moving average occur after the trend has already changed direction. While traders are able to show profits on paper using lagging indicators such as moving averages, my experience suggests that even several day lag can be very costly, or several period lag, and even devastating in real trading due to the stress of weathering the late signal. So my friend Bob uses a lot of indicators that combine moving averages. Now, a type of moving average that attempts to overcome the lag is the displaced moving average. Ordinarily, when computing moving averages and using them as some sort of crossover oscillator approach. Now, Let's start out. First, we have simple moving averages. And for those of you who don't know the difference of the different types of moving averages, simple moving average is where you're using a 10-period moving average. And most moving averages are based on the close. Not all. And today, the computers give us too many choices, but most moving averages are based on the close. So if we're using a 10-period moving average, we go back to the close for the last 10 periods, add it together, and divide it by 10. So in other words, if gold was trading at 1250, 1250, 1250, 9 frames back, and now it was trading at 1275, we'd add 1275 and the last 1250s together, divided by 10, and we get a moving average that's somewhere around maybe 1260. Because the thing about moving averages is that all simple moving averages, it doesn't give any more weight to the most current price. So if the most current price had a big jump up or a big jump down, it gets lost in this calculation. Now, in an attempt to correct that, over the years, we've come out with several different types of moving averages. We have EMAs or WMAs. Both of these, which stands for weighted moving average and exponential moving average. Exponential is the most popular. What an exponential moving average or a weighted moving average, it tries to give more value to the last time segment. Whether it stayed the same, jumped up, or jumped down a lot, we want to give that a little bit more value because we're only trading in the most current time segment. So by using an exponential moving average, and gold was at 1250, 1250, 1250, 1250 for 9 periods, and it's 1275 now, our exponential or our weighted moving average might be at 1264 instead of 1260 because it's moved more in conjunction with that last big time frame. But it still leaves us behind the market because if gold was trading at 1250, 1250 and jumped up to 1275, most likely it's in a rally, and we're just a little bit behind getting that buy or sell signal. But an EMA has helped us. So most of our indicators today use EMAs as opposed to just simple moving averages because it was the most advanced method we had not too long ago. Before we had online trading, before we had all of these, computerized charts and all this stuff. Sure, if you were a big hedge fund, you could tell a programmer, I want to use this, and this, and he'd come back and he'd write you a long, involved program, and you could add something new into your charts or your little black box trading method. But to us common folks, unless you want to do a whole bunch of calculations by hand, or you're a pretty smart computer whiz, and even until recently, we didn't have the ability to add this in or even write scripts to the indicators to put on our charts. So even if you were able to do the calculation, you'd have to hand place it on your charts. But today, all of our advanced charts, let's go over actually, I knew this is getting boring, so let's go over to a live chart and take a look. Okay, here we have, let's get rid of these other indicators in the bottom of my chart. And here we have a current Euro US dollar chart. And we have on here I'm going to add on here a moving average, standard moving average, which is just a simple moving average. And we're going to add that on for 12 periods for no other reason. Okay. Now, if you don't understand why you would use what periods and what time lengths and time frames you'd use for moving averages, you need to come to our class on understanding moving averages. But today, for a class in our example, we're going to be using just two 12-period moving averages. Let's make this right, and I want to make a thick line. Okay, so what I have on the chart right now for you is a 12 period based on the close, simple moving average. That simple moving average is the dark red, is the reddish orange line. Okay. Now, I've also put on that chart a 12 period exponential moving average. Same calculations, but it's now an exponential, so it's giving more weight to the most recent time movement. And you can see there's a variation between these two lines. Both are 12 period, but one's an exponential moving average and one is a simple moving average. So this is our simple moving average. This is our exponential moving average. So what it's done is it's taken a large lagging indicator, like a moving average, and by giving more weight to the most current movements, it's moved it closer to be from a bad lagging indicator or a far lagging indicator over towards being a leading indicator. Still can't move over to the field of being leading because it's still using the previous prices. Now, because of these marvelous computers we have, we can add what we call a displacement. Well, I just got to get my marker to this moving average. So I'm going to add another moving average onto my indicators. And I'm going to leave this one at a 12 period also, so we can compare. Okay, let's make this one an easy to see color. We're going to make this one, ooh, purple. That should stand out. Okay. So the purple and the orange are now over top of each other. So let's get rid of the orange because we don't need to see that anymore. Yes, we do. So I'm going to take this 12 period moving average that we just did in purple. And what we're going to do is we're going to displace it. Doesn't change the calculations at all. What we're telling the computer is to put it on our chart 3 periods forward. So it's the same exact calculation as the moving average as this orange line. But what we've done is we've taken that total and moved it 3 time frames forward to put the dot on the chart. What that's done is now move this indicator into the future, making it a almost leading indicator. Now 3 is only the displacement I use. That means we're looking at a 30-minute chart. We've put the total of this moving average value 3 time frames or an hour and a half forward. So it's trying to predict where the price will be an hour and a half. Now, that's rather interesting because it moves it from a lagging indicator into a leading indicator. Let's go back to my PowerPoint and let's talk about this a little bit before we add it into some more things. So a type of moving average that attempts to overcome the lag is the displaced moving average. Ordinarily, when computing moving averages and using them as some sort of crossover or oscillator approach. So imagine what we're doing is if we're using a 10 and a 20 period moving average crossover, and we displace them forward, when we get that crossover buy or sell signal, it's more accurate and more up to date. So displacing a moving average is the practice of just shifting the value forward in time. This turns the moving average into a leading indicator, as it is now predicting where the trend will be in the future rather than telling you where it has been in the past. For example, if the moving average is displaced forward in time by 5 periods and you believe that the trend is going to hold relatively steady, then you have a visual marker of where the price will be if you're correct. Now, this can be helpful in timing entries and picking where to take profits. Now, because number one, this is fairly new, the strategy of displaced moving averages isn't. The ability for us to put it easily on our charts and use it is fairly new. And because of that, there's not a great deal of literature on it. And it's also fully customizable. So it is you who needs to test it in your strategy. Okay. So a displaced moving average is shifted forward in time, turning it into a leading indicator. So as you can see on this chart, we have prices just in the black as a standard line chart. We have the displaced moving average on the chart, and we have a regular moving average. We could make a strategy based on when the displaced moving average and the regular moving average crosses over, or we can see when the displaced moving average crosses price. So if you shift the regular moving average on your chart to the right or to the left, now to the left is moving it backwards. I don't know anybody who's ever used this. I don't know any strategy that's combined it together, but you have the ability to shift it backwards instead of forwards. Many trading strategies display moving averages as improved over regular moving averages. So when this is done, the lag is evident on the charts as the market trends higher, for instance, and the moving average trails below the actual daily prices. Similarly, when a market reverses abruptly and starts to trend lower, the moving average lags above the actual price and briefly may even continue to increase as the value of the market is just declining. So the assumption behind displacing today's actual moving average value forward in time is that the future period's actual moving average that has not yet occurred will in fact be equal to today's moving average, or the next time frame's moving average. This is, of course, a very simplistic forecast of the future period's moving average value. However, it is a forecast, not just a linear extrapolation from past price data, such as you achieve by extending a support or resistance line to the right of a price chart. More research and testing of the substitute approach needs to be done before a recommendation can be made. Now, I've started adding this for the last 2 years, actually, into my trading. I feel more comfortable with this displaced moving average, and I use a displaced moving average. I've moved my moving average crossover strategy to a displaced moving average crossover strategy. And I find personally for me in my decision-making capabilities for my trading that it works pretty well. So conversely, when the predicted moving average is less than today's actual moving average, the market is expected to move lower. The difference between the two moving averages measures the strength of the expected move. Now, let's go over back to the charts for a minute. Now, if we were to take, let's get rid of these moving averages that are on here. Now, if we were to take and add on here Bollinger Bands. Now, Bollinger Bands is based on a 20-period moving average, okay, which is the brown line going through the chart here. And then its upper and lower boundaries are based on two standard deviations. Standard deviation is a very complex statistical calculation that's based on that 20-period moving average value. If we were to take this 20-period moving average and offset it by 3, okay, we've now just shifted it forward in time. So let me put 2 of them on the chart so you can see Bollinger Bands. Oops. Okay. Now let's try that again. Indicators, Bollinger Bands. So as you can see, I've overlaid one set of bands on the other. Okay. And actually, let's see if we can color code them so you can see the difference. Okay, so the orange color band, oh, hold on, I got to do one more step on this. The basis band, let's make that blue. Okay, so the orange colored band with the blue center line is now the standard Bollinger Bands, which is using a 20-period moving average. And there's two standard deviations. The green band is the same calculations, standard moving average of 20, and we've offset the moving average by 3 places forward, which then shifts the whole band forward also. So now, do we get a more accurate reading? Do we get better signals? Do we get better information? It's something you'll have to test. I'm not a Bollinger Band trader. I know Bollinger Bands, but I don't use it in my trading strategy. But it should move this from a lagging indicator to a leading indicator. Okay, so will this improve your trading? Will this improve your volatility? Will it improve where you put your stop loss and take profits using the bands? It might. It's an interesting theory. I've never used it, like I said, with Bollinger Bands. I keep reading articles about it. I keep reading different statisticians who are using them. I don't use Bollinger Bands. So for me, it doesn't, I can't tell you exactly. Okay. But it then, like I said, it's moving this from a lagging indicator, a confirmation tool, to a predicting tool. If we were to take something like MACD, let's get rid of our Bollinger Bands here. And MACD is based on 2 moving averages, because the first calculation is MACD line below here, if you understand MACD. But the MACD line that's down here, which is called the MACD line, is the difference between a 12 and a 26 period EMA. And if you take one and the other and subtract them, it gives you the difference, and the difference is that blue band. But if you were to take them and shift them forward 3, okay, because now the signal line band is a 9-day smoothing of that blue band. And where they cross over, it generates buy and sell signals. Now, you would do the same thing by using the offsets, but this gives you a particularly interesting scenario. Again, it requires some testing. It requires you to see exactly how it works. It desires you to see whether you want to use a 2 offset, a 3 offset, a 5 offset, whether you're using a 15-minute chart or whether you're using a 1-hour chart. But it opens up a whole bunch of information or theory to you that you can then build a unique strategy that isn't something that's so overly complicated that you can't do it. It doesn't require computer programming. It doesn't require science and math. It requires testing. So it's a philosophy. It's not a philosophy. It's like I said, a theory, a theorem, whatever we want to call it, that you might want to think about. So let's go back to my PowerPoint. So when we talk about the moving average crossover strategy, if the predicted average crosses the actual moving average from above to below, so that difference between them shifts from positive to negative. This confirms that the market is ready to make a drop or reverse. Depending on an individual trader's risk tolerance, as well as his own trading style and objectives, he might tighten his stops or close out a trade once the difference narrows even slightly. More aggressive traders might even reverse positions prior to the crossover actually occurring. Other more conservative traders might wait for the crossover to take place before putting on a position. But by displacing it, we're now getting ahead of the markets. While it is similar in many ways to typical moving average crossover methods that we all are familiar with, by forecasting the moving averages, Bob has found a way to overcome their lag and effectively transport this popular technical indicator from a trend lagging into a trend leading indicator. Using the same technology that allows moving average forecasts, this approach also can predict the next day's high and lows of a target market and the next period's highs and lows. Precise accuracy is not necessary to help traders identify entry and exit points or to set trailing stop losses. In Bob's case, he's working with a relatively small account and considers himself a conservative trader. So he adopts stops in all of his trades. Depending on each market and depending on each trader's own risk tolerance, the dollar amount of the stop can differ. But using a moving average, a displaced moving average can help you determine where you'd want to put them. So rather than using a fixed dollar stop, Bob can use the high and low predictions. For instance, the predicted high and low ranges can be used on subsequent periods to move his trailing stop. So if Bob is long the euro based on the forecast of the target market and expected to continue to keep rising, he might set his stops a few ticks below the predicted low to act as a support level. Traditional support and resistance trend lines are used by too many traders, and their stops often are bunched together and frequently get hit. Using a predicted high or low to set stops may lessen the likelihood of being stopped out during intraday price swings. The predicted high and low reliability bracket, the actual high and low of the following trading day or the trading period, provide good guidance for stop placements. So it's unrealistic to expect any indicator, regardless of its construction, to be able to tell you what the future trend direction of a market will be with complete accuracy. The Holy Grail is yet to have been found because it just doesn't exist. There's no magic bullet, but a lot of research, hard work, and lessons learned can help you avoid common pitfalls and gain a competitive edge. So how do you recognize which displaced moving average you need? Well, the answer to that question is simple, and I've said it a couple times. It's trial and error. So as you see here, there are some swing lows which conform to the moving average, the displaced moving average, and use it well as support. So the best ways to do it is to put it on your charts. See how well it's reacting to those price charts and determine what period. You might find for the assets you're trading, you're better off with a 5, or you might be trading from 5-minute charts. So you only want to displace it, two time frames. It depends on how fast you're trading. It all depends on you. On the other hand, there are a few where the price crosses below the displaced moving average. This means that the moving average might be better to be displaced in the opposite direction. And that's, like I said, shifting to the left makes no sense to me. I don't know anybody who's done it, anybody who's using it. But how do you adapt displaced moving averages indicators to your strategy? We're going to go through 3 suggestions of how DMAs can be combined with other trading indicators. This will give you some idea how you can combine the indicator to your existing strategy. Suggestions 1. By using a simple moving average and combine it with displaced moving average. And you can then combine that into a moving average crossover strategy. So on this chart, we were using a 50 period SMA and a 50 period DMA. Of course, for our trading, and it depends whether you're a day trader or swing trader, whether you're trading in 15-minute segments, whether you're doing lots of small trades, real quickly, or whether you're looking for a trade to be open all day, which moving average you might want to use. You might want to be a 10-period moving average trader, okay, and combine a 10 SMA and a 10 DMA. Two is combining a positive and negative displaced moving average for the same period. SMA, so it's saying take a 5-period, say hypothetically 5-period displaced moving average plus and a -5 place moving average, and then combine that with a simple moving average where you're going to get 3 different moving averages, which gets very confusing, and it requires you to completely test this and test and test and test. But that's another one of the possible scenarios. You see, you open it up to all types of choices for you. And suggestion 3 is you can use a displaced moving average and a simple moving average and combine that with stochastics or RSI. So when you get the crossover and then you get an overbought or oversold in stochastics or RSI, you can then do a buy or a sell execution. We are using the oscillator to determine trade opportunities as a result of the crossovers of the moving averages. This is by far the busiest of the trading strategies mentioned. You will need to determine if so many indicators on chart create sensory overload for you. But wait for the RSI and stochastic to enter an overbought and oversold area. Next, wait for the leading DMA to cross the simple moving average. When we then open a position, once all of these indicators are aligned and provide the same signal. We close our position when the RSI goes to the other extreme, the opposite direction. But for me, I simply like to use a simple moving average and displaced moving average crossover, or the same periods I have for my trading strategy, whether I'm using a 12 and a 26, but instead of using an EMA or an SMA anymore, I just convert them to a 3-period DMA. So we are using the settings that Bob used for his DMA channel. The other thing is you can set a channel by using a 6-period high displaced to the right and a 6-period low displaced to the right, and build a channel. Okay, and we could say that above the displaced moving average would be a buy, below the longer period displaced moving average is a sell, and in between is no man's zone. We can get a lot of information to form the basis for a trading strategy by looking at the charts, especially about our trading bias. The secret is to use a higher time frame as your bias for trading direction, a lower one for your trading. So displaced moving averages offer a lot of new opportunities. Are they a good trading strategy? Okay, this is a simple trading strategy, especially if you swing trade. It's clear cut and easy. I think that displaced moving average channel frames price quite well and gives us a chance to buy above and below. And then using it as a crossover offers us a great, taking an old set acceptable method and moving it to a new generation. So trading signal generated when the DMA and the MA cross. If the DMA crosses above, a buy signal is generated. Conversely, if the DMA crosses below, a sell signal is given. Nothing new. It's a moving average crossover strategy. Been around since the day, since the medieval times, just about. But we're just applying it to adding, instead of using a shorter and a longer, we're using a DMA instead of two SMAs. So shifting the indicator forward is just a new way to use an old indicator. So displaced moving averages in different directions has distinct implications. Displacing moving average to the right introduce more lag, and displacing to the left aids in cycle analysis. The displaced moving average is a great way to adjust a regular, simple moving average to fit a trend line. It's the same function as a regular, simple moving average to determine support and resistance. If the moving average is displaced with a negative value, it is shifted to the left, and it is more laggy. If the moving average is displaced with a positive value, it is shifted to the right and becomes leading. Trial and error is the way to discover the right displaced moving average for you. Displaced moving average can be combined with other trading instruments to clarify signals from the market. So some of these are simple moving average. You combine it with momentum indicators like RSI or stochastics, or you can use it with chart patterns or candlestick patterns or retracement levels. The DMA does the thing a normal moving average does, but in some cases, it may do it better because it's better tailored for the assets being traded. In general, the DMA helps determine trend direction. When the price is above the MA, that helps indicate an uptrend, or at least that the price is above the average. When the price is below the MA, the price is below the average, which is a sign of a downtrend. When the price moves through the MA, this could signal that the trend is changing. However, the MA is displaced can aid in providing better reversal signals. Assume that in the past, the uptrending price has just slightly dropped below the MA, only to rally once again shortly after. In this case, the price dropping below the MA wasn't a reversal signal, and the MA just didn't fit the price action well. Displacing the moving average by several periods may help keep the price above the moving average, creating a better fit for the asset's trend, and thus avoiding some of the false signals. So an MA is the average price of an asset over a period of time. It does not inherently have any predictive calculations factored into it. Therefore, any MA, including a displaced one, won't always provide reliable information for trend reversals and support and resistance levels. But it gives you a new opportunity to try something new and fresh and make it your own. So thank you very much for joining us this evening. And I've given you two handouts tonight, if you look on your screen, that you can download. And that's the Moving Average Guide handout and the Technical Indicators Guide from investing.com. Both of these will help you building a strategy to incorporate moving averages as well as DMAs. So thank you very much for joining us. Take a second and click those download buttons because they're only available during the live class. And have a good night, and thank you for supporting UBCFX as well as investing.com.